Record.
Okay. So we're going to be presenting the financial analysis of Nike and Under Armour. We have Michael, Christina, Samantha, Taylor, and Antonia. So obviously the Nike logo, the Under Armour logo, and which company is worth investing in. We're going to find that out. Alright, so the net income from Nike in the years 2014 to 2016 rose steadily from $2.7 million in 2014 to $3.2 in 2015. And also to $3.7 million in the year 2016 for Nike. Nike has also maintained growth since 2014, with receivables being well above inventory. Nike's net income in February 2016 through 2017 remained strong. The same goes for stockholders' equity. Nike's overall worth exceeds $100 billion. Nike's current assets since 2014 have been well above their liabilities and has remained that way. As with Nike, Under Armour's net income rose steadily each year. It was $208,000 in 2014, $232,000 in 2015, and $256,000 in 2016. Under Armour also remains strong and able to meet its short-term obligations for lenders. Its value continues to grow, which is good for Under Armour and its customers. And that is from the U.S. Secretaries and Exchange, 2017. Alright, so in the next slide, we are going to be looking at the profitability, or is this probability? So Under Armour has a slightly higher current ratio. In 2016, Under Armour had a higher rate of 0.7 in current ratio. When it comes to net working cap, Nike takes the lead. In 2016, Nike's net working cap was 10% higher than Under Armour. Wow. Measuring the liquidity of a company is broken down in several parts: the current ratio, a quick ratio, and the working capital. From 2014 to 2015, Nike's ratios deteriorated, but then improved from 2015 to 2016. From 2014 to 2015, Under Armour's current ratio went down, but also continued to fall in 2016. Under Armour's quick ratio dropped significantly from 2014 to 2015, but then improved again in 2016. Under Armour's working capital dropped a noticeable account from 2014 to 2016. Under Armour's current ratio went down as well, but continued to fall in 2016. With these facts, it's easy to see that Nike is obviously the better company to choose. So we're going to go to the next slide, and Michael's going to come up and read.
All right, hello. All right, so we're looking at profitability here. Profitability is another important factor to consider when looking at a company's financial analysis. Nike's ROA increased from 2014 to 2016, which is a good indicator that the company has profited well. Under Armour's ROA percentages decreased from 2015 to 2016. This trend can be seen throughout the ratios for both companies, with Nike's profitability increasing and Under Armour's decreasing. Nike had a higher percentage on return of assets in 2016. Nike had a higher return of 9.6%. Under Armour did have a slightly higher percentage when it came to gross profit margin. Earnings per share were also larger with Nike, leading by 1.7% in 2016. Assets turnover as well as inventory turnover ratio in the Acctg analysis was higher with Nike. In this section of the financial analysis, Nike again has a better overall profitability. Okay, so we're looking at activity analysis. Under Armour's asset turnover ratio and accounts receivable ratio are both more favorable than Nike's. Days sales and accounts receivable had a higher rate with Under Armour, exceeding by 2.7% in the year 2016. Nike's assets turnover ratio deteriorated significantly from 2015 to 2016. According to the provided data and information given, it appears that Nike is once again the better choice. We're going to bring in Samantha now.
Debt to equity ratio was higher in Under Armour in 2016. When observing the data, it shows that 2015 produced a higher debt to equity ratio in Nike. Interest coverage ratio was higher in Nike in the years 2014 to 2016. The price per earnings ratio was higher in Under Armour for the years 2014 to 2016. In 2016, Under Armour was 41.56 higher than Nike. In 2016, it was higher by 3.86. When it came to market to book ratio, for years 2014 to 2016, ROA was 852.63 for the company Under Armour and 1006.80 for the company Nike. Therefore, Nike outshined Under Armour. Capital market analysis. Price earnings ratio of Nike are at a higher rate, which indicates healthier growth. Nike's market to book ratio has gone from 322.07 to 108.32. It is not as profitable as Google. Okay, ROA represents each cent earned on each dollar of assets. Since the ROA for Nike is higher than Under Armour each year, it has a better return. The data listed is relevant as the two companies are similar. Nike wins again.
All right, so now we bring it to the evolution of cash flow. The cash flow statement is important for internal and external evaluation. It provides the analyst with how cash is used within the company's operating, financial, and investing activities. The sum of these activities is equal to the net cash flow. When analyzing the company, it is the operating activities, the day-to-day, that are weighed the most. The debt ratio reveals that Nike is able to maintain better control over profits and investments necessity. Overall, when deciding to invest in either Nike or Under Armour, the best decision is based upon the information would be Nike. So investors, don't think about it, just do it. The data provides enough information to conclude that Nike is more efficient firm compared to Under Armour's, as shown in the liquidity profitability analysis. Nike's cash flow provided from the operating activities revealed that they are consistently better than Under Armour's. Nike is overall the top contending company in the industry and continues to provide excellent profits for investors. So Nike wins.